Welcome back, everybody. We're here with our panel, John Rutledge, David Reilly, Barry Ritholtz. Barry Ritholtz?
Yes, sir.
Shouldn't we throw out Sarbox?
Absolutely not.
It's unconstitutional, number one, and it's over-regulating, number two.
Well, let me clarify a few of the things that Professor Starr had mentioned. First, there's a reason London is attracting so much IPO activity. You know, our banking fees here are 7 to 9%. In London, things go out for less than 3%. So it's more than twice as expensive just from the investment banking fees in the U.S. That's one thing. Second, you know, the Enrons and the WorldComs and the high-profile debacles, Sarbox wouldn't have done anything about them. But there were hundreds and hundreds and hundreds of companies that phonied up their earnings, that overstated things. There's a reason the NASDAQ is still down 55%, and that's because a lot of the earnings that drove us to over 5,000 were phantom. They didn't exist. I think the regulation to force CEOs and CFOs to attest it's accurate is important. That doesn't mean we shouldn't exempt small companies.
Hang on, don't do the on the other hand. I want to get John Rutledge.
No other hand.
I want to get John Rutledge to critique what Barry Ritholtz just said. John, is it all about banking fees, or are we over-regulated with Sarbox?
Throw Sarbanes-Oxley out the window. It sucks. It makes it virtually impossible to be the officer or director of a company today. All the things it's designed to attack have other laws to prevent them. I agree with Barry about London, but you know, Singapore and Hong Kong are also big competitors today, and they're catching an increasing amount of the IPOs coming out of Asia. But I think basically Sarbanes-Oxley is a Small Business Prevention Act. We need to allow small cap companies to come in the market instead of have to go private.
All right, David Reilly, you want to weigh in real quick, and then I want to move to hedge funds. Go ahead, David.
Yeah. I'll disagree with Barry a little bit. I think that Sarbanes-Oxley is having an observable effect on entrepreneurship and the ability to take risk. And his points about the cost of doing business in London are good ones, but nonetheless, anecdotal evidence seems to indicate we are losing business on the exchanges due to the regulatory overkill of Sarbanes-Oxley.
All right, let me go around another one. Hedge funds. Sebastian Mallaby in today's Washington Post writes a very interesting op-ed piece. He says the SEC is going after hedge funds, another SEC overregulation. Hedge funds stand accused of being risky, Mallaby says, hence the SEC's proposal to raise the bar for investing in them from the current $1 million in assets to $2.5 million in assets, excluding your home. And then Mallaby goes on to say, but investing in hedge funds is not actually riskier than another practice that the SEC condones cheerfully, investing in individual stocks. So Barry Ritholtz, do you think we should just regulate hedge funds again?
Look, if you're dealing, the reason I like Sarbox is it's protecting a small investor. If you're dealing with a sophisticated accredited investor or an institution, they don't need protection. They have their own team of lawyers and accountants. It's the little guy, the small investor.
So why is the SEC doing this, Barry, in your judgment?
Hey, listen, you know, they're political entities. It's a popular thing. Quite frankly, most of the hedge funds out there have been underperforming this year. If left to its own devices, a lot of that money is migrating to index funds and to managed accounts. So I think if they left it alone, it would fix itself just due to the performance
John
function.
Rutledge, Chris Cox, somebody you and I have both known very well for years, supposed to be a free market guy. Here he is implementing Sarbox. I know they may be making some changes around the edges, and he's going after hedge funds. Do we need all this, John, or are we in an era of re-regulation that could be bad for the economy and the market?
I think the political environment, people have still got their buttocks clenched since the crash in the market. It's bringing on all this over-regulation. Chris is a really smart guy, but he's a politician, and we don't need hedge funds regulated. Everybody knows they're risky.
Dave Reilly, what do you think about the hedge fund thing? I mean, you know what? They go after hedge funds. Guess what? You know who's next? You all are going to be next. You're going to have tougher regulations because they're going to say, you guys are too risky.
The problem with hedge funds, to the extent one exists, is that it's structural in nature. You don't have transparency, you don't have liquidity. At the end of the day, for many retail investors, you don't know what you own. So I'm not sure raising the minimums is the right response to that. There are ways to access hedge fund-like returns, and if you think of what a hedge fund is all about, that is some level of absolute return, usually in a strategy that has low correlation with equities. That's wonderful for investors. So the problem is to sweep away the structural flaws associated with hedge funds.
You know, if well-to-do people want to go into interesting investment vehicles, I don't have a problem with that.
Yeah.
Re-regulation, we are going down the wrong road. John Rutledge is right. There's too much politically correct politics on re-regulation in Washington. Anyway, thanks to John and to David Reilly and to Barry Ritholtz.